So now I wanted to get on to our next segment, which is about the Bank of Canada and speculating what the Bank of Canada is going to do going forward. And as I said off the top of the show, we received some inflation data recently. The CPI data came out, and our first chart that we have will clearly show this. And it talks about how CPI has come down. We've actually seen CPI come down to 2%. And if some of you are sitting there saying, hey, I know, I recognize that 2% number. Yes, it is the target rate for the Bank of Canada. It's also the target rate for the Federal Reserve in the US. They want to see an inflation rate of 2%. And so here we go. We have it. And the interesting thing is, when you compare that to what the Bank of Canada rate is currently, the bank rate is, you're looking at a rate of about 4.25%. It was 5% earlier this year. It's come down 3 times and now at 4.25%. So as you can see by this chart, things are moving in the right direction, but you can still see that the difference between 2% and 4.25% is more than double. So that tells us that, yes, the Bank of Canada has a lot of room to continue to cut rates. The question becomes, how quickly and how much are they going to cut per meeting? And recently, CIBC Bank has come out and said that they believe the Bank of Canada will cut more aggressively, perhaps as much as 50 basis points cut at the year-end meeting. Their last meeting for the year might be 50 basis points, followed by maybe 50 basis points early in 2025. So taking a more aggressive stance on interest rates. And I'm not so sure about that. And I'm not so sure that people won't call into question the credibility of the Bank of Canada. You know, they raised rates 10 times very quickly without hesitation. We talk about this lag effect when you raise interest rates, what it means for the economy. And we all know that it just doesn't change things right away. It takes some time before the economy feels the effects of an interest rate increase. And so here we are with the Bank of Canada now cutting rates 3 times in a row. And perhaps they'll cut maybe 4 or 5 times in a row before the end of the year, and maybe even a 50 basis point cut. Does that mean that the Bank of Canada went too high, too far, too fast, only to now cut back? I think that's a question that some people are going to ask. And I guess, there's definitely a consideration for cutting more or cutting quicker. And the next chart that we have, which is Canada GDP, has stalled. It shows GDP stalling. You can see the orange line here. So Canadian growth definitely flatlining, not really going anywhere. At the same time, if you look at the blue line, which is the unemployment rate in our country, now above 6.5%, highest level we've seen in quite some time. At the low end, unemployment was somewhere around 5.5%. Now it's well over 6.5%. So you look at unemployment rising, you look at GDP stagnant, and you look at inflation finally reaching our target of 2%. Well, what's keeping the Bank of Canada from cutting rates aggressively and quicker? Well, the answer may be in our third chart here, which is housing. And what we see here is any point in time where the Bank of Canada cuts rates, obviously those areas of the economy, interest-sensitive areas of the economy, like real estate, like housing, they tend to benefit when rates are cut. And obviously, it is a negative for those or that sector of the economy when rates go higher. So we've seen spikes in housing, home sales. We saw a spike in 2009. We saw a spike just after COVID. Again, rates that were cut, housing really took off. And now we've seen housing coming down over the last couple of years, and that's because interest rates went higher. Well, what happens if we start cutting rates even more aggressively than we already have? Well, does that mean that housing goes out of control again? And that's something I don't think the Bank of Canada wants to see. I don't think that's something government wants to see. And I know even all of us would not like to see housing prices, just start to go like gangbusters once again. It'll be very difficult, even though maybe a mortgage rate might be lower for individuals. But if the price of a home is skyrocketed once again, that's going to be a difficult thing. And so I think even though we've seen the Bank of Canada or we've seen the inflation rate reach our target of 2% here in our country, it doesn't mean that the Balancing Act and the questions and I guess the Bank of Canada kind of walking on some eggshells here. That doesn't end. They have to figure out now how to deal with perhaps an increase in unemployment. And remember, the central bank mandate is for full employment and price stability. Well, we now have price stability. So now I think the Bank of Canada is going to tackle this unemployment or full employment issue. So going forward, I believe the Bank of Canada will continue to cut rates. I don't think there's much doubt about that, but I'm not so sure that they're going to cut as aggressively as some are calling for or perhaps predicting. But again, time will tell. And as always, if they continue to cut, it will be a stimulative for certain parts of our economy, perhaps our banks, our housing sector, perhaps some utilities, dividend paying stocks, I think will get a bit of a boost. So definitely we will see some stimulation for our markets, for the interest sensitive parts of our economy if the Bank of Canada continues to cut and if they were to cut more aggressively.